Okay, good afternoon, everyone. So today we are going to solve one important question based on the cost method. So we are now in chapter 4 and we are preparing consolidated financial statements. So on the date of acquisition, the only relevant financial statement is the consolidated balance sheet. So remember your chapter 3. Chapter 3, we learned how to prepare the consolidated balance sheet at the date of acquisition, on the date of acquisition. For example, January 1st, 2020, for example. January 1st, 2020 is the acquisition date, and at that day, how to prepare the consolidated balance sheet, we already learned. If you forget, go back to my previous lesson of chapter 3. Now, after acquisition means we are now chapter 4. We are now chapter 4 after acquisition. A complete set of consolidated financial statements. A complete set of consolidated financial statements must be prepared for the affiliated group. Who are the complete set? We have to prepare mainly income statement, then retained earnings statement, balance sheet, and the cash flow statement. So today we are going to learn these three: income statement, retained earnings, and the balance sheet of consolidated financial statement for the affiliated group. Okay, so this date is something like this: the financial statement preparation date. So usually we prepare financial statement on December 31st. So this is the financial statement preparation date, right? At the end of the year, we prepare the financial statement. So this is called after acquisition. This is the after acquisition. We are going to prepare mainly income statement, retained earnings statement, and the balance sheet. And today we are going to follow cost method. So we have two methods, you remember. We have equity method and we have cost method. So if you don't know equity method, or sorry, if you don't know the cost method, you are going to do mistake here. So I suggest you to learn more about the cost method first, then try to solve this question. So let's read the question first. On January 1st, 2020, Parker Company purchased 95% of the outstanding common stock of the seed company for $160,000. So we have some important point here. So we have to figure out who is the parent company. Parker is the parent company here. Subsidiary seed company is a subsidiary. This is subsidiary company. So we figure out parent company. Then we figure out subsidiary company. And we find that parent company only acquired 95%, not 100%. So as it is 95%, we have to think about CAD schedule. For NCI. So chapter 3, we learned how to prepare this schedule, how to prepare this schedule for non-controlling interest. We learned from chapter 3. So you have to prepare this schedule. Then another part of the question said that at that time, that means at the time of acquisition, subsidiary companies' stockholders' equity consisted of common stock, $120,000 common stock, Other contributed capital means additional paid in capital. Additional paid in capital means it is others contributed capital. It is $10,000. And retained earnings is $23,000. So don't forget that this is beginning retained earnings. Beginning retained earnings. Because in the question later on, you have to calculate the ending retained earnings also. Okay, but we have to close or we have to eliminate the beginning retained earnings. So this number is important. So this is the introduction part. From introduction part, we see some important points. So here, so we have a book value. Book value are the common stock, additional paid in capital, and retained earnings. And we have investment $160,000, and it is 95%. Anyway, requirement: prepare a consolidated statements. Here, consolidated statements means income statement, retained earnings, and the balance sheet through a work paper. On December 31st, 2020. So this is just balance sheet, financial statement preparation date. So I told you that we are chapter 4. We are preparing consolidated statements after acquisition, and this is one of the date after acquisition. Because company acquired, you can see that company acquired this company when? Company acquired this company January 1st, 2020. Now we are just December 31st, 2020, financial statement preparation date. How to prepare work papers for consolidated financial statements. And requirement B said that how to prepare another work paper just after 1 year later. Just after 1 year later. So this is the first question about. I told you that we have to begin our consolidation process by preparing the CAD schedule. For NCI. This is the first step you have to do. So if you want to solve this question accurately, you have to begin with the CAD schedule to establish non-controlling interest. And again, chapter 3, you learn this concept, how to prepare. So I'm just going to show you the solution, but not explain too much. So we have the first column here. You can see that 95% interest. This is for parents company. Then 5% interest for NCI. And this is the total value of the company. Now, we are going to see what is the purchase price and implied value. So I already explained how to calculate the implied value in my previous lesson. So according to the implied value, the total value of this company is 168,421. Okay, so you should know how to do that. So this is the total 100% value, but parent company acquired only 95% and paid $160,000. So this is 95% share, 95% share of the parent company, and remaining 5% is the non-controlling interest, 8421. So we are in this schedule. We are compare the implied value and the book value. So the main aim of this part is compare book value versus implied value. So we already know what is the implied value here. Now let's see book value. So If you remember chapter 3, we have 3 book value according to this question. One is called the common stock. Another is other capital. And another one is called retained earnings. So we have these three components for the book value of subsidiary. And the question tell you this information, you can see there here. The common stock is 120, common stock 120, then other contributed capital $10,000. This is $10,000. Then retained earnings $23,000. Retained earnings $23,000. So this is the total common stock, other capital, and the retained earnings. Now 95% belongs to parents company, right? 95% belongs to parents company, and 5% belongs to non-controlling interest. So we are going to allocate this now. So 114,000 for parent share of common stock, and 6,000 for NCI. Then 9,500. This is 500. This is 21,850. 1,150. Now we are going to calculate the total book value. Total book value is, if you add these three, the total book value is 14,550, and here it is 7,650, and here it is 153,000. So we find this is the total implied value, right? For parents company, non-controlling interest, and total, and this is the book value. And our formula is implied value minus book value. Implied value minus book value to calculate the difference. So we are going to calculate a difference. We are going to calculate the difference between implied value and book value. What is the difference here? Difference here is 14,650. Here difference is 771. And here difference is 15,421. So this is the difference. Now you have to read the question that we find a difference. Now the question will tell you where should we allocate the difference. Clear? When you stop, come here, then read the question carefully. Where should we allocate the difference? And we read the question here. The question said that allocate difference to where? Allocate difference to the goodwill account. This is the part of the question. Clear? So it means that we have to make our difference 0. So that means balance. The balance should be 0. Balance should be 0. Why balance should be 0? Because question said that we are going to allocate this difference. We are going to allocate this difference to goodwill account. That means we have to create a new account called goodwill. Goodwill. Now, how to make it difference? How to make it 0? This is positive at this moment. Why positive? Because implied value is higher, book value is lower, right? Implied value is higher, book value is lower. So this is a positive. But maybe another question, this may be negative. Why this may be negative? Maybe book value is higher, implied value is lower. So be careful that difference is positive or negative. Here difference is positive. Now we have to make this difference 0. How to make it 0? Just make it negative, right? Make it negative. Make it negative. But another question may be opposite. If difference is negative, if you want to make it 0, make it positive. So we make it 0, right? Now we don't have any difference. Before we find that we have a difference, question said that we have to allocate this difference to goodwill, we allocate it, and now the difference is 0. So this is, I repeat again, begin the consolidation process by preparing CAD schedule to establish NCI. Clear? And also we learned this from our previous chapter. Anyway, now another part of the question. Another part of the question. On December 31st, 2020, the two companies' trial balance were as follows. And we know that trial balance, we have two columns for trial balance. One is debit, and another is credit. So we have two columns for the trial balance, debit and credit. But this question give you all the debit together, okay, all the debit together and all the credits together. You understand? So these are the parents companies and subsidiary companies, some accounts. So for your information, do it quickly. Cash is asset. So in the exam, you don't need to show me, but as this is the first class for this chapter, I am going to show you who are the assets, who are the liabilities. So we have cash is asset, accounts receivable is our asset, inventory is our asset, and investment in subsidiary. Asset for which company? For parent company. Look at here. Investment in subsidiary. SID means subsidiary company is asset. Is asset for which company? For subsidiary company, right? This is the asset. Then plant and equipment, we have asset. Land, this is asset for both company. So up to here we find the asset. Up to here we find some asset for subsidiary company and parent company. Then dividend declared. Okay, dividend declared. This is the part of equity. You know that this is a part of equity. This is a part of equity, but it is debit balance. Dividend is debit balance, you know that. Dividend declared is debit balance. Now, as the dividend came, don't forget that we are going to follow cost method. We are going to follow cost method, right? According to the cost method, okay, dividend is the revenue for parent company. Can you remember? Cost method said that if parent company receive dividend, it is recorded as revenue or dividend income or dividend revenue. It is important. Otherwise, this is cost method. But in the equity method, we have another treatment. In the equity method, dividend is not revenue. Clear? So according to the cost method, dividend is our revenue. So don't forget this. So company declared dividend, it is part of the equity. We have income, I will show you later on. So cost of goods sold, we know that this is expense. Cost of goods sold is our expense. Then other expense is our expense. So we find that some accounts are assets, some accounts dividends under equity method, dividends goes to equity section, not equity method, equity section. Then cost of goods sold expense, and accounts payable is our liability. Accounts payable is our liability. So accounts payable is our liability. Other liability we have here is other liability. Then common stock is the equity section. Common stock is the equity section. Other contributed capital means other additional capital. It is equity sections, retained earnings, equity section. Then this is sales revenue. This is sales revenue. And this is also called revenue. Under which method? Under cost method. Under cost method, dividend income is the revenue. Don't forget this. Clear? So look at here. This is the parent company received $19,000 because how many sorry, how many dividend declared? How many dividend declared by the subsidiary company? $20,000. Look at here. $20,000 dividend declared by subsidiary, right? And how is your portion? Your portion is 95%. And 95% is your revenue. 95% is your revenue. So it is given in the question. It is given in the question. You don't need to calculate here. So this is the question about, question give you a trial balance. Now this is the solution format. This is the solution format. You can see that this is 2020, December 31st. December 31st. And we are going to prepare income statement. Okay. This is the parents company's information. This is the subsidiaries company's information. Okay. And what is the meaning of consolidation? Consolidate means combined. P plus S. Can you remember? So this is the parents company, right? Parents company's information. This is the subsidiary company's information, and the last column is the consolidated. Consolidated means combining, right? Combining P plus S. Can you remember? Yes. So here, these two columns, first two column came from first two columns came from trial balance. It is given in the question. So trial balance we already have in the question, right? You can see that this is the trial balance. In the trial balance, we have P and S. And we have different accounts here. We have different accounts here. So based on this trial balance, we have to complete this column. We have to complete the first two columns based on the trial balance. Clear? Then we have elimination entries that we already learned in chapter 3. We already learned how to do the elimination, right? Then chapter 3, we already learned how to establish NCI. Clear? This is from our chapter 3. We already learned this. And we also learned how to add consolidate, P plus S. Now let me do the income statement first. So in your exam, I will give you a blank sheet like this. Okay, you will have a blank sheet and you have to solve this by yourself. So how to prepare income statement, you already learned from your previous accounting courses. First, you start with revenue, right? So you look at your question already have sales revenue. Question already have sales revenue. So for your information, it is here, sales revenue. Sales revenue. So we have sales revenue. Clear? Then according to cost method, if parent company receive any dividend, it is the revenue, right? It is the revenue. So our question said that we have dividend income. We have dividend income. So you can write dividend income or you can write dividend revenue. It's your choice. Okay, dividend income. And how much? $19,000. Only for which company? Only for parent company. Subsidiary don't have this information because we receive this revenue. Parent company received this revenue from whom? from subsidiary. So this 2 column is the revenue. So now we can write total revenue. So we have revenue. Sorry, we have total revenue. Parent company's revenue is $279,000, and subsidiaries company's revenue is $80,000. $80,000. So I believe you understand up to here, because income statement is start with revenue. Then revenue minus expense, right? Revenue minus expense. So I already mentioned here we have some expenses. Look, we have cost of goods sold, right? We have cost of goods sold, this is the expense. Cost of goods sold is our expense. Cost of goods sold is our expense. So we have expense. We have another expense according to this question. According to this question, we have another expense, this one. Other operating expenses. We have other operating expenses. So we have these 2 expenses. Now we can write total expenses. And the total expenses, you can add these 2. You can add these 2. This is $150,000. $150,000 and $54,000. So revenue minus expense, revenues minus expense equal net income. Revenues minus expense equal net income. Now the net income is $129,000 for parents companies, and subsidiary companies is $26,000. $26,000. Okay, so you understand up to here? Then come to the retained earnings statement. Retained earnings. Retained earnings. Can you remember the formula for retained earnings? Beginning balance plus, yes. So if we have any net loss, so it should be something like this. So as our question do not have any net loss, so beginning balance plus net income, then can you remember minus dividend declared. Dividend declared equal ending balance. Ending balance of retained earnings. Retained earnings. So we have all information. We already know net income. We already know the net income. This is the net income, right? Then we already know the beginning balance of retained earnings. Our question, I told you here, beginning balance, right? Beginning balance $23,000. So beginning balance $23,000. Or we have beginning balance $23,000 for subsidiary. Yeah, this one for subsidiary. this one for subsidiary. So we have the question. Retained earnings. Yes, so this is $40,000. So we know beginning balance, we know net income, and we also know dividend declared. We also know dividend declared. In both cases, $20,000 dividend declared, right? So beginning balance plus net income minus dividend declared equal now ending balance of retained earnings, and it is 149,000 for parents companies, and subsidiary companies is 29,000. You understand, right? So we find net income statement, retained earnings, now balance sheet. So balance sheet here, you can see that we have cash. Then we have, you can do it by yourself. Then we have accounts receivable. Then we have inventory. Then we have investment in subsidiary. So parents don't have this, a subsidiary don't have this information. Investment in subsidiary, this is the asset, right? Then plant and equipment, the asset. Plant and equipment is asset. Then land is asset. Land is asset. So you understand up here? Cash, accounts receivable, inventory in subsidiary, plant and equipment, and assets. So can you remember in the non-controlling interest, here we have a difference column. Can you remember? So we have difference and we transfer difference to which account? Transfer difference to the goodwill account, right? So it should go under balance sheet because goodwill is the balance sheet, you know that. Goodwill is asset, right? Goodwill asset. So here we are going to show you it this way. First we write difference between implied value and book value, right? First we write difference, implied value and book value. So trial balance don't have this information, right? Trial balance don't have this information. And we have a goodwill we can write here. So you can see that we are going to keep this blank. We are going to keep this blank because I told you that this column is only for which part? Trial balance, right? But as it is under balance sheet, goodwill go to the balance sheet, right? Goodwill go to the balance sheet. So I create a new cell. For goodwill. And I can show you how this goodwill came. Goodwill came from this, the difference. So you can do this two column, okay, and keep it blank. Here. So we done the asset part. Now we can write total asset. Total assets according to the trial balance, okay? According to the trial balance, total asset is $418,000 for parents company, and subsidiaries companies is $191,000. Now here, I forget to tell you, I keep one cell here. Look at it, this net income, this part is for the parents, right? This part is for the subsidiary. So we should have another net income. We should have another net income for NCI, non-controlling interest. Okay, so we will write this amount here later on. We'll write this amount here later on, okay? But as we are keeping net income together, right? We are keeping net income together. So this net income, one for parents company, one for subsidiary company, and we should have another net income because NCI, you know that NCI 5% is their money, right? 5% is for NCI. So from this information, can you guess what should be the number here? Consider this cell, okay? Net income parent company $129,000, subsidiary company $26,000. So what should be the net income for NCI? Can you guess this number? Anyone can guess this number? What should be the net income for NCI? 1,300. Yes, very good. 1,300. Later on, I will show you this calculation again. 1,300. Just for your information, as this is the net income, right? As this is the net income for parents and subsidiary, we should have another cell. We should have another cell for net income of NCI. Look at it, $26,000 for subsidiary, right? 95% is yours, right? 95% is yours, and 5% for non-controlling interest. So anyway, I will show you this calculation later on. And this is also net income, but the total column, net income, and for the total amount. Net income for total amount, and this is this. Do you understand? So don't be confused. First, we calculate net income. Try to understand. First, we calculate net income, parent company and subsidiary company. As it is income statement, look at here. As it is income statement, so we should have a cell. We should have a cell for net income of NCI, right? And we have a specific column for NCI, right? We have a specific column for NCI. So here it is 1,300. I will show you later on calculation. I can delete it now. I can delete it now. So we should have a net income for NCI also. Then, as it is the trial balance, we have to calculate the total, right? We have to calculate the total. So it's the total net income for parents and for subsidiary. Same here. When we prepare a balance sheet, we create two cell. Okay, we create two cell. Although we are not going to put any information here because it is not given in the trial balance. Okay, but we create two new cell. One cell for difference, another cell for goodwill, because according to the question, we are going to allocate the difference to the asset account, right? Question said that allocate this difference to the goodwill account. So this is under balance sheet. So total asset, then liability. We know that total asset, then we have to write the liability. We have liability here. So you need to do a little bit practice for this chapter, easy chapter, but if you do not have good practice, you cannot write the cell account information clearly. So this is the accounts payable. So I suggest you do more practice for this chapter. So accounts payable, then we have other liability. We have other liability, then we have common stock. We have common stock for common stock. Then we have other contributed capital. And you know that we should have retained earnings here. So now when we prepare balance sheet, we should have ending balance of retained earnings. Do you understand? We should have ending balance of retained earnings. And we already have this ending balance. We already have this ending balance. Do you understand? We already have the ending balance of retained earnings. You know that balance sheet. So we have two retained earnings. One is beginning retained earnings. Look at here. One is beginning retained earnings given in the trial balance, right? But we calculate ending retained earnings. And this ending retained earnings should go where? Under balance sheet. Now I make different color. There is a reason. There is a reason why I make different color. You can see that this net income, okay? Pink. This is pink, right? This net income is this net income, right? Then this retained earnings is this green retained earnings. So whatever you have in this row, in this cell, try to understand. Whatever you will have in this cell, everything should come here. Everything should come here. Clear? Otherwise you will do mistake. That's why I make different color. I repeat again. We have a pink cell here. It is the net income, right? So whatever we have this net income, we know the formula, beginning retained earnings plus net income, right? So this pink cell, whatever you will have here in future, everything should come here. Then look at the ending balance of retained earnings. So ending balance of retained earnings, we put here, right? We put here. So whatever you have this cell, everything should come here. Okay, otherwise you will do mistake. If you can remember this, very easy for you. So for the balance sheet, we know asset, we know liabilities and equity. Now we are going to add. I told you that we already established NCI, right? Think about here. We have net income. And we create a new cell for NCI net income, right? Same equity account. We have to create a cell for NCI. So it's very simple. NCI beginning balance. And we should have NCI ending balance. Same here, you can see that net income do not have any beginning and ending, right? Net income do not have any beginning and ending. So we have a net income for NCI and it should come here. It should come here, right? It should come here. I will show you the calculation. Then we have beginning NCI and ending NCI under which account? Under equity. Under equity. So here you should not have anything because it is not from balance sheet, trial balance. Be careful. This is not from trial balance. So you keep here. So this number will come here later on. This number will come here later on. This number will come here, okay? But here we know that we have to create two new cells for NCI, one for beginning balance, one for ending balance. And we create a new cell for net income. Okay, we will put here there because we have to go step by step. First, we done trial balance part. First, we done the trial balance part, right? Then we have to come to the elimination part. Elimination, we need to do some journal entry. That's why I write here debit and credit. In the I repeat again, for the elimination, we need to do some journal entry that we already learned from chapter 3. But today we are going to do the same, and I will add one more journal that I will show you very soon. Let's go to the journal entry, elimination. So we already done first part, you can see. Each section of the worksheet represents 3 consolidated financial statements like income statement, balance sheet, right? And retained earnings. We already done this. We already done income statement. We already done retained earnings. And we already done balance sheet. Now, second part, that means these are the steps. These are the steps. So I put these steps. Maybe in the exam, I may not ask you to do that. Okay. I don't know at this moment, but this is the workings that will help you to solve the question clearly. So we have to go through these steps. We already done step 1, right? We already done step 1. Then we have to do the elimination journal entry. So now I'm not going to explain too much about the elimination that I already explained in your chapter 3. First, we have to eliminate book value of the subsidiary, right? That means common stock. Common stock, if you make it debit, okay, if you record common stock debit, it is going to close. Common stock, other capital, and retained earnings. And I told you that it should be beginning balance, beginning retained earnings. We should close the beginning retained earnings. Now, according to this question, our subsidiaries common stock is $120,000. Then other capital is $10,000, and beginning retained earnings. Beginning retained earnings is $23,000. So it means that we close book value of subsidiary. Clear? Then we have to close investment in subsidiary. We have to close investment in subsidiary, and according to this question, it is $160,000. $160,000. And I told you that as it is 95%, we have to establish NCI. We have to establish NCI. And we already calculate NCI. Look, we already calculate NCI here. This is the NCI, right? This is the NCI. So NCI is now credit side. We put credit side. Now, after doing this, you have to find out where should you write the difference. Difference, I told you in chapter 3, the difference sometimes debit, difference sometimes credit. So according to this question, where is the difference? Debit or credit? Difference between implied value and book value. Where should we write this? Debit side or credit side? Debit side, because debit is lower. Yes. So you will do this part at the end. Last is here. Last part, you will write the difference, either debit or credit based on the question. So it is 15,421. Difference. Now, this is the elimination, right? This is the elimination. This is the elimination column. Now, question said that we allocate the difference. We allocate the difference to which account? Goodwill account, right? Look, we make the difference 0. We make the difference 0. How 0? Before we record debit, now we record credit, right? Now we record credit and make it 0. Clear? So goodwill account is this. I can show you that. So if we write difference in the credit side, if we write difference in the credit side, now difference close. Difference becomes 0, right? Debit and credit 0, and we established goodwill account. We established goodwill account, and it is here. So we learn chapter 3, we learn up to here, right? Now chapter 4, we have to eliminate. We have to eliminate additional point. It is called inter-company transaction. What is the meaning of intercompany transactions? So if there is any transaction between parents company and subsidiary company internally, we have to eliminate them. Okay. Do you understand? Because we are doing consolidated financial statement. We are going to add P and S together. Do you understand? Parents company and subsidiary company's balance are going to add together, right? So if there is any intercompany transaction between them, we have to eliminate them. So according to this question, we have a dividend. That means subsidiary company declared dividend and parent company received this dividend, right? So these accounts should be eliminated. For your information, if you remember your principles of accounting 1 course, so dividend declared is debit. When we record dividend, okay, when we record dividend declared is debit. For example, $19,000, for example. $19,000. And last class, we learned that according to the cost method, we record dividend. Okay. Last class, okay, we record dividend income, credit. So these are the two accounts. These are the two accounts for dividend. You can see that $19,000. Just I put a number here. Now we have to close these two accounts because subsidiary company declared dividend. Try to understand. Subsidiary company declared dividend. When they record dividend, they record it debit. Okay. And when parents company, so this is from subsidiary company, S company. S company record dividend declared debit, and parents company record P company. P company record dividend income credit, right? And you know that we already record dividend income. We already record dividend income according to the cost method. We already record dividend income here. Do you understand? We already record dividend income, right? Because we follow the cost method. So, and this is called intercompany transactions. So as we already recorded income, okay, so we have to eliminate. We have to eliminate if we have any intercompany transactions, especially for dividend. Now, how to eliminate them? So we already look at here. We already record income. We are the parents company. We already record subsidiary companies dividend as our income. So how to close it? Now dividend income should be debit. Now dividend income debit. So if we write dividend income debit, and dividend declared credit, okay, then it is closed. It is closed. Now the question already gives us what is our dividend income. Our dividend income is $19,000. We already have this information in the question here. Dividend income. So this dividend income is the intercompany transaction, right? For the parents company. So we are now preparing consolidated financial statement for parents company. So this is intercompany transaction. We close it. We close it. We close. So 2, 3, and 4. 2, 3, and 4 are based on elimination. You can see that 2, 3, 4. 2 is elimination, right? 2 is elimination. After eliminating, we eliminate difference and we establish goodwill, right? So 2, 3, and 4. 2, 3, and 4. This is also elimination of difference. So 2, 3, 4 are the eliminating journal, right? Now go to the worksheet. In the worksheet, we have these 2 columns for elimination, right? And we have debit and we have credit. So debit item go to the debit side, credit items goes to the credit side. Clear? Now first we can see that 120 debit of common stock and it is subsidiary. So this is a subsidiary side, we make it debit. We make it debit. We make it debit, not here, sorry. This is accounts payable. Here. Clear? So this is 120 subsidiary companies and we make it debit and it is closed, right? It is closed. Then this $10,000, look at here, $10,000 debit. We copy all debit first. It is closed. Then we have $23,000. $23,000 beginning retained earnings, right? Beginning retained earnings debit. So where is the beginning retained earnings? This is the beginning retained earnings. We put it here. It is closed, right? Because we will have only ending balance of retained earnings. Then we write difference in the debit side. We write difference in the debit side. And we already have a cell for difference. Look at here. We already have a cell for difference, right? Remember, we already have a cell for difference debit. And you know that this difference goes to where? This difference goes to the goodwill account, right? Goodwill account. So this difference goes to goodwill account. So this is the elimination row. Where is the goodwill? We put in the goodwill. Clear? Then we have another debit. We have another debit of dividend income, right? Do you understand? This is intercompany transaction we have to close. Dividend income, $19,000 debit. So what is the dividend income according to this question? According to this question, this is the dividend income, right? This is the dividend income and this is the elimination column and this is debit. So we copy all the debit and paste debit in the debit side. Now go to the credit side. Credit side, investment in subsidiary is credit. Now what is investment in subsidiary? This is investment in subsidiary. We put in the credit side. We put credit. Then we have another credit, 8421. 8421 is the NCI, right? And this is the beginning NCI. Clear? This is the beginning NCI. So we have, I told you that we have to create a new account, new cell for beginning NCI. So this is the beginning NCI. At the time I make a question mark. Now I can delete this. This is here. No, this is here. This is elimination. This is the elimination. Elimination. My mistake, not here. Elimination column. I repeat again. This is 8421 NCI. Okay. And this is the elimination column. This is the elimination column I put here. NCI. Then we have, look at here, we have difference credit, right? Difference credit. We put difference credit. So look at here, interesting things. Difference debit and credit close, right? Debit and credit close, and we establish goodwill. And we have another credit called dividend declared. And you know that this dividend declared is for subsidiary, right? This dividend declared for subsidiary, yes, company. This dividend declared from subsidiary and this dividend revenue from parents company. So both are intercompany, so we delete it. So now this $19,000 credit, what is the dividend declared? You know that this is the dividend declared, right? Dividend declared, and this is credit. This is credit. This is credit. Do you understand? Now, because I have to finish today's class anyway, so now we make it, because this is the total column, right? This is the total column. Now here, what should we write here? This one. Do you understand? This is the total column. This is the total column. Then I told you that this pink is the net income column, right? Cell, net income cell. So we have another cell of net income. Do you understand here? I told you that whatever you write in the pink, everything should come here. Everything should come here. So we have a new amount here, 19,000. We put here 19,000. Do you understand? Now look at here. 19,000 and 23,000, because the formula is here. The formula is beginning balance plus net income, right? Beginning balance net income, and we don't have any amount here. So now this is $42,000. Do you understand here? Now I told you that every green should follow here. Every green should follow. That means this 42,000. This 42,000 is the retained earnings ending balance, right? I put here. Clear? Then we have 19,000 here. So this 19,000 we will put where? We will put here. Do you understand? Again, it is green, right? We copy here and put here. What happened? Because this 19,000 we put here. We put here. Now we have this one we put here. This one we follow everything. We follow everything. Now these two accounts should be equal, because debit and credit. Okay, debit and credit. Now these two accounts should be equal. Yes. So you can do it. It is something like 2,842. Yes. So you can add everything and we will find this. You will find this number. So we just done trial balance and the elimination. The next class I will tell you NCI and the consolidated balance. Very easy, just plus and minus. As we don't have time today, so I will do it in the next class. So we have to do NCI, then and consolidated retained earnings, some other things later on. So you need a little bit practice. This is easy. But if you do not have practice, you may have chance to do mistake. So I will continue this in the next class. Okay. Thank you very much.